Silver has officially broken above the $90 level, and this is not just another routine price move. This is a structural breakout that the market has been building toward for months. The $90 level was not random. It was psychological resistance, technical resistance, and narrative resistance all combined into one powerful barrier. Now that barrier is gone. When silver breaks a major resistance level like $90, it sends a message. It tells traders that buyers are willing to pay higher prices. It tells institutions that momentum is shifting. And it tells long-term investors that the structure of the market may be changing. But here's the real question. Is this just a short-term spike? Or are we witnessing the beginning of something much bigger? To understand what just happened, we need to look at the road that led to this breakout. Silver has been volatile for weeks. It faced repeated rejections near the $88 to $90 zone. Every time it approached that area, sellers stepped in. That created a visible ceiling on the chart. Markets remember ceilings. The more times a level is tested, the more important it becomes. Each rejection builds pressure. Each pullback creates frustration. And each new attempt increases the probability of a breakout. That pressure has now been released. The break above $90 was not subtle. Volume expanded. Momentum indicators flipped bullish. Short positions began to unwind. The move forced traders who were betting against silver to cover their positions. Short covering fuels rallies. When traders are forced to buy back silver to close losing positions, their buying adds fuel to the fire. That is often how breakouts accelerate. What begins as a steady climb can quickly turn into a sharp spike. But technical factors are only part of the story. Silver is not just a precious metal. It sits at the intersection of investment demand and industrial demand. That dual nature makes it more volatile than gold. When global uncertainty rises, silver can move like a safe haven. When industrial activity strengthens, silver can move like a growth asset. Right now, both forces are at play. Geopolitical tensions have increased safe haven demand. Investors are looking for protection against uncertainty, currency weakness, and policy shifts. At the same time, industrial demand for silver remains strong, especially in sectors like renewable energy and electronics. That combination creates a powerful backdrop. But we must also examine the macro environment. Interest rate expectations have been shifting. When investors anticipate easing monetary policy, precious metals often benefit. Lower rates reduce the opportunity cost of holding non-yielding assets like silver. That narrative adds momentum. Inflation expectations also matter. If investors believe inflation will remain persistent, tangible assets like silver become more attractive. Historically, silver has acted as a hedge during inflationary cycles. Now combine inflation concerns with geopolitical stress and shifting rate expectations, and you have a cocktail that can drive explosive moves. Still, we cannot ignore the technical structure. Breaking $90 changes the chart. What was once resistance may now become support. That is one of the most powerful transformations in technical analysis. When a ceiling turns into a floor, it signals a change in control. Sellers lose dominance. Buyers gain confidence. The next levels to watch will likely emerge quickly. Markets rarely pause for long after major breakouts. If momentum continues, traders will begin targeting the next resistance zones above $90. Those targets become magnets for price. But breakouts are not always linear. Sometimes markets retest the breakout level. A pullback toward $90 would not necessarily be bearish. In fact, a successful retest can strengthen the move. It confirms that buyers are defending the new support zone. This is where patience matters. Chasing parabolic spikes can be risky. However, ignoring structural shifts can be equally costly. The key is understanding whether the breakout is backed by volume, sentiment, and macro alignment. So far, the alignment appears strong. Another factor driving silver's surge is the gold-silver ratio. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold. When silver begins outperforming gold, it often signals increasing risk appetite within the precious metals space. Silver tends to move more aggressively. If gold remains stable while silver surges, it suggests traders are rotating into higher beta exposure. That rotation can amplify silver's gains during bullish phases. There is also the institutional angle. Large funds often wait for confirmation before entering positions. A breakout above $90 provides that confirmation. It removes uncertainty about resistance. It signals strength, and institutions tend to follow strength. Momentum attracts capital. Capital fuels momentum. That cycle can continue longer than many expect. Retail participation may also increase. Headlines about silver breaking $90 generate attention. Attention generates interest, and interest often translates into new buying activity. But emotional buying can create volatility. It is important to distinguish between sustainable demand and hype-driven spikes. Sustainable rallies are supported by consistent flows and macro tailwinds. Hype-driven rallies often reverse sharply once excitement fades. Right now, silver's move appears structurally supported, yet markets always carry risk. Let's talk about potential risks. A stronger-than-expected dollar could pressure silver. If currency markets shift abruptly, precious metals can face headwinds. Similarly, unexpectedly hawkish central bank signals could dampen enthusiasm. Markets are sensitive to policy language. Another risk is overextension. When prices move too far too fast, short-term corrections become more likely. Even in strong bull markets, pullbacks are normal and healthy. They reset momentum. They shake out weak hands. They prepare the market for the next leg higher. If silver consolidates above $90 instead of collapsing back below it, that would be constructive. Sideways movement after a breakout often signals accumulation rather than distribution. Accumulation precedes expansion. Expansion drives trends. From a long-term perspective, breaking $90 could be part of a larger multi-year structure. Silver historically moves in cycles. Long periods of consolidation are often followed by explosive upside phases. This breakout may mark the beginning of such a phase. Investors should also consider supply dynamics. Mining output does not increase overnight. When demand accelerates quickly, supply constraints can intensify price pressure. Silver's industrial uses add another layer of complexity. The renewable energy transition continues to require significant silver input. Solar panel production alone consumes substantial quantities of the metal. As green energy investments expand, structural demand may remain elevated. That is not a short-term story. It is a long-term narrative. Meanwhile, investor psychology plays a crucial role. Markets move not only on data, but on belief. When traders collectively believe a breakout is real, they position accordingly. That positioning reinforces the move. Belief becomes momentum. Momentum becomes trend, and trends can persist longer than skeptics anticipate. Yet discipline remains essential. No breakout guarantees straight-line gains. Risk management separates professionals from gamblers. Position sizing, stop placement, and scenario planning matter more than excitement. The breakout above $90 is significant, but how traders respond to it determines outcomes. If momentum builds and volume sustains, silver could target higher psychological milestones. Round numbers often act as magnets in financial markets. Just as $90 mattered, future levels will matter too. Psychology shapes charts. Charts shape decisions. Decisions shape markets. Zooming out, this breakout reflects broader shifts across global markets. Commodities have been regaining attention. Investors are reconsidering hard assets in portfolios traditionally dominated by equities and bonds. Diversification themes are re-emerging. Silver benefits from that shift. In times of uncertainty, tangible assets provide perceived stability. Even though silver is volatile, its physical nature gives it enduring appeal. Now the narrative has changed from, "Can silver break $90?" to, "How high can silver go?" That is a powerful shift. When resistance becomes memory, traders look forward rather than backward. The ceiling no longer defines possibility. Instead, momentum defines opportunity. However, experienced participants remain cautious. They understand that confirmation requires follow-through. A single daily close above $90 is important, but sustained trading above it matters even more. Consistency builds confidence. Confidence builds participation. Participation builds trend strength. Watch the next few sessions closely. If silver continues printing higher highs and higher lows, the breakout gains credibility. If volatility increases but support holds, that is constructive. If price collapses back below $90 with heavy selling, that would weaken the bullish case. At this moment, buyers hold the advantage. The structure favors upside continuation. But markets are living systems. They adapt, they respond, they surprise. Silver. Breaking $90 is not the end of the story. It is the beginning of a new chapter. Whether that chapter becomes a historic bull run or a sharp but temporary surge will depend on how fundamentals, sentiment, and liquidity evolve. For now, the message is clear. A major resistance level has fallen. Momentum has shifted. Attention has returned to silver. And when attention and momentum align in financial markets, moves can become far larger than most expect. The breakout has happened. The market is watching. And silver has officially entered a new phase.